What if I told you the Fed's rate cuts won't make buying a home easier? Everyone thinks lower interest rates mean cheaper mortgages, but that's not what's actually happening. In this video, we'll break down how the Federal Reserve's new rate policy is changing your mortgage, your monthly payment, and the entire housing market. By the end, you'll see why falling rates don't always mean affordable homes, and what this really means if you're buying, selling, or refinancing in 2025. A lot of people think that when the Fed cuts rates, your house payment will suddenly get much cheaper, and if you're trying to buy a house, you might think it's about to get easier. But here's the truth. It's not that simple. The real effect of a rate cut depends on a lot of other things, like how many houses are for sale and the overall cost of living. Most importantly, the market for home loans is like a big, powerful team that makes its own decisions. So, while you're waiting for rates to drop a tiny bit, you might be missing the point. If you buy now because of rate cut, you might regret your action. If you wait, you could end up paying less, or more, for the same house later. In September 2025, the Federal Reserve finally cut its main interest rate for the first time in nearly a year, from 4.5% down to 4.25%. On paper, that sounds like good news, but the reason behind it? Not so good. Jerome Powell called it a risk management cut. Basically, the Fed's way of saying, we're not in trouble yet, but we're getting nervous. Jobs are slowing. Unemployment is climbing. And inflation is still lurking in the background. But here's what no one's talking about. Even as rates fall, homes are still out of reach for millions of Americans. So what's really going on? Even though the average 30-year FHA mortgage rate fell from about 6.65% in May to around 6.1% in mid-October, the lowest in almost a year, here's what surprises most people. Mortgage rates started falling before the Fed actually cut rates. That's because the housing market often reacts to what it expects the Fed will do. Mortgage rates don't move exactly with the Fed's rates. They're more tied to 10-year Treasury bonds and to what investors think will happen with inflation and the economy. That's why rates can rise or fall even when the Fed isn't doing anything. Some experts say the recent drop might not last. Unless the Fed keeps cutting, mortgage rates could flatten or rise again. So timing the market is tricky for homebuyers right now. Even though mortgage rates are lower, homes aren't becoming more affordable. The Housing Affordability Index dropped from 101.7 in January to 98.8 in July. That means the average family now earns less than what's needed to buy a median-priced home. Why is that happening? Because home prices are still about 50% higher than they were at the start of the decade. Incomes haven't kept up. Add in rising insurance and property taxes, and total housing costs are through the roof. Lower rates may help current homeowners refinance, but they don't help much if you're trying to buy your first home. Many buyers are still priced out. The real issue: not enough homes. Here's the bigger picture. The US simply doesn't have enough homes. The country is short by around 4 million homes because we haven't built enough for years. Even if rates fall, that shortage keeps prices high. Builders are struggling with expensive materials, labor shortages, and tough local rules that make it slow and costly to build new homes. As Fed Chair Powell said, that's not a problem the Fed can fix. Some homeowners are also staying put because they don't want to give up their old low-rate mortgages. That means fewer homes are listed for sale, keeping inventory tight and prices high. The Fed expects the economy to grow slowly this year, around 1.6%, with unemployment rising to about 4.5%. Inflation is still hovering near 3%, higher than the Fed's goal of 2%. If inflation rises again, the Fed might stop cutting, or even raise rates again. That would push mortgage rates back up, so there's still a lot of uncertainty ahead. We'll be watching future reports like job numbers, inflation data, and the Fed's next meetings to see where things go from here. What this means for you. For buyers, today's lower rates are a small win, but home prices and limited inventory are still big challenges. For homeowners, it's a good time to refinance if you haven't already. But the truth is, the Fed can't solve the housing crisis alone. Fixing affordability means tackling deeper issues, like building more homes, reforming zoning laws, and investing in local infrastructure. So, what did we learn? That the Federal Reserve's rate cut has created a complex landscape where mortgage rates have declined a little while housing affordability continues to deteriorate, revealing that lower mortgage rates alone can't fix the housing shortage. That real affordability requires more homes, better policies, and smarter local action. Additionally, we learn about the limitations of monetary policy in addressing structural housing market challenges. If you found this breakdown helpful, hit like, subscribe to Home Smart Academy, and drop a comment below. Do you think the Fed's rate cuts will make homes more affordable, or is it too little too late? And if you want to learn more about housing trends and how they affect your financial future, check out our other videos on the channel. Thanks for watching. See you in the next one.